Vanguard just came out with their latest study where they share their views on how the stock market and the various segments of the stock market are going to do over the coming 10 years. It's important reading that I want to share with you. Unfortunately, the news is not good, but they actually came out with two reports. One is their market outlook, where they share their views on the stock market and the returns for the future. But their second one takes that base case and talks about artificial intelligence and the impact that that could have on the stock market and returns. And you're going to want to see that, so be sure to stay to the end. But let's talk about their market outlook first. And unfortunately, they're forecasting that returns are not going to be as healthy in the future as they have been in the past. So let's go through it. The study is called the Vanguard Capital Markets Forecast. And again, over the last 10 years, and the first one is their U.S. equities. And with U.S. equities, they're calling for, instead of the historic, let's call it 7 to 10% that the stock market has done over the last 50, 60 years, they're basically calling for averages to come back down, and pretty dramatically. They're calling for that to drop to 3 to 5.5%. You can see that on the table on the screen. And then if you look at the global equities, outside of the United States, they're actually calling for those returns to be pretty healthy, in the neighborhood of 6 to 8.5% per year. And then if you look at global equities without the U.S., just in the developed markets, so the larger countries, more developed countries, and you can see that's pretty healthy too, in the neighborhood of 6 to 9%. And then we get into emerging markets, and that's a little bit lower. That's in the 6 to 8%. But then they break down the U.S. stock market into value and growth and large cap and small cap, and then also REITs, which are real estate investment trusts. So let's look at this. U.S. value they have at about 4% to 6%. U.S. growth, which for the most part is going to be the S&P 500. That's traditionally when you say U.S. growth, or at least S&P 500 is going to be a big piece of this. Look at this. They're calling for, over the next 10 years, 0 to 2% per year. That's dramatic. That's a big drop versus what the S&P 500 has done historically. And I think part of the reason for this is the S&P 500 has really been the darling of the stock market for a long, long time. And it's been one of the top performing asset classes. Now, does that mean it's going to continue to be one of the top performing asset classes? Maybe. Nobody knows. And anybody that says that they know is not being candid. So just because it's done well in the past, does that mean that it's now going to go back down? It's called reversion to the mean. Go back down and be below average for a period of time, where these other asset classes like value and small cap catch up. Well, according to Vanguard, if you look at this, they're saying 0 to 2.5% for U.S. growth, and then U.S. large cap. That should be the S&P 500. That is in the neighborhood of 2 to 4.5, maybe 5%. U.S. growth would have been like technology companies. Companies with very fast growth. And so those would be companies that would also be included in the S&P 500. And then the U.S. small cap, which are smaller companies that in theory we're taking more risk, because smaller companies are more likely to face hurdles as they grow, right? They don't have the same access to capital. They don't have the same competitive position, what Warren Buffett would call their competitive moat. A moat being the river around a castle that kind of protects the castle from attackers. So smaller companies don't have many of the advantages that large companies have. So bigger risks, so hopefully bigger returns. Let's see what Vanguard says there. They're saying for U.S. small cap, 4 to 6% return. And then finally, for U.S. real estate investment trusts. Now, we all know real estate has done very well. You have to be careful with real estate investment trusts, because the real estate that's done very well is the residential side of real estate, but the real estate investment trust invests in all kinds of things. They invest in shopping malls, which I have to feel are feeling a lot of pressure, given all the cardboard boxes, at least, that show up at my house. So U.S. Real Estate Investment Trust, which covers a large swath of real estate in the United States, they're saying 4 to 6%. So these numbers are dramatically lower than what they have been historically. Okay, and then the next section I want to talk about is the second report, which talks about potentially the impact of artificial intelligence as a breakthrough technology that could really have a positive impact on the U.S. stock market and really the world stock market. And the idea there is companies, hopefully, will be able to do things better, faster, and cheaper. And my hope for artificial intelligence is that it's an enabling technology, that each worker will be able to get more done. And the more work we can do, the higher our productivity is. And hopefully, some of those gains, some of that extra profit that comes from workers being able to get more done in a day passes through to our paychecks. That's my hope. It doesn't always happen. But Vanguard did release a report here, and it's by their global chief economist, and it's called Technology and Demographics, the Economic Tug of War. So the technology, the main technology in this article is artificial intelligence. And what they mean by demographics is, a lot of people are starting to phase out of the workforce. And it's the boomer generation, were called the boomers, right? Because it was this explosion in population. And each generation after the boomers has fewer and fewer people in it. So the demographics get tougher. The country's going to have fewer workers to produce the same amount of goods and services. And that can negatively impact the economy. Okay, and so what Vanguard is saying is, their consensus scenario, which they're giving the probability of 10 to 20%, is that it's helpful, that the technology is helpful. Let me read what they wrote. The economic future will resemble its most recent post-pandemic productivity growth, which is 1.8 to 2.3%. So that's their base case, although it has a lower probability. They're saying that it's likely the economy is either going to do better or it's going to do worse. And for the worst scenario, which they place at a 30 to 40% probability, they're saying that the demographics, the fact that there's fewer workers involved, we have less people to produce goods and services, that's going to negatively impact how much the U.S. can produce, and that could have a negative impact on all of our wages and the wealth in the United States, and could also have a negative impact on the stock market. And they're putting a 30 to 40% probability of that happening. And then their positive scenario talks about having growth greater than 2.3%. Now, in the recent past, our GDP growth has been, they're saying, 1.8 to 2.3%. So again, that's their base case, that things stay the same. Worst case is things get worse, and that's mostly driven by an aging population and fewer workers. But then there's the technology side of things. And they're saying greater than 2.3% GDP growth, gross domestic product, which is the value of all the goods and services produced here in the United States. And they're giving that a probability of 45 to 55%. So it's not their base case, but they do see it having a higher likelihood of happening at the 45 to 55% likelihood. And so if we look at that, as well as a chart from their investment and economic outlook that just came out as I'm recording this, you can see this chart of technology over time. It starts in 1890, and it lists different technology. Like, we chuckle at this now, but the availability of electricity for factories and just in our homes, and just what was what was made possible by having electricity first in factories and then also in homes. And then another technology that came along, and just how that impacts our GDP growth over time. And what they're saying is these are step changes in the productivity of workers. And if that happens again with AI, it could have a very positive impact on the economy and the stock market. So what do I think is going to happen with this? I do think that artificial intelligence is the next frontier. For instance, it was probably 30 years ago as I record this that the internet really started to gain traction with everyday Americans and enabled us to, not initially, initially the internet allowed us to waste a lot of time, and we've kind of gone full circle on that, but now the Web 2.0, we have real businesses that have been built, obviously, on the internet. And I think for the most part, it's enabled all of us to do our jobs better, faster, cheaper. It's an enabler. And that's what I think is going to happen with artificial intelligence. I hope things like the Terminator and scenarios like that never happen. But that's my thought on that. And I also think while we need to be cognizant and we need to be thinking about what are the stock market returns going to be in the future, we also need to think about what's best for us individually. How long should we continue to work? Because not only is our money a limited resource, right? We don't get as much of that as we want. The other limited resource, there's really two important ones. One is our health, and the other one is our time. And how much healthy time do we have? And that's why I made this video here that talks about 5 reasons to retire as soon as you can. Thanks for watching this video, and I look forward to seeing you in the next one. Bye-bye.